No, I think, wait, hold on. Yeah, it's like, oh, we're live. Hi, Josh.
Hey, all
I'm so
right.
sorry. Like, I'm like literally like so excited because every time I'm like having a heart attack on if this is live. But hi, Josh. Welcome to Venture with Grace.
Thanks for having me, Grace.
Quick shout out to Showmick for the introduction, just because he's awesome. Anyway, okay, so let's start with I wanna just talk about like, two of your most like amazing thing that you have done for your career. One is like starting Threshold Ventures, and then the other one is like I feel like previously you built your career and track record from DFJ. Maybe we could talk about like the core lessons that you've learned early on in your career as a younger VC to now you're like an industry expert and basically the OG here. So why don't we talk about like the early things that you feel like influence your career later on?
Oh boy, I mean, where to start? There's a lot. So maybe as background, so as you mentioned, I've been doing venture for a little more than 20 years now.
Mhm.
Roughly the first half of that at DFJ, where I was started as an associate and then was a partner and eventually one of the managing partners. And then for the last roughly 10 years at Threshold. So Threshold was basically an evolution, a spin out of DFJ, where we took the venture team from DFJ and kind of reconceptualized the strategy. And I can talk later about sort of the guiding
Mhm.
principles there. But it was very much focused around the idea that bigger is not better.
Mhm.
And wanting to bring more of a sort of craftsman and kind of handcrafted boutique approach to venture.
Mhm.
That was actually informed by my own experience as an entrepreneur, as well as being a VC at a larger fund. So prior to being a VC, I worked at a couple of companies, a startup, Microsoft, BCG, some others. But I'd also in '99 started my own software company, and
Mhm.
DFJ was one of my first investors. So I
Mhm.
raised 3 rounds as an entrepreneur. I had VCs on my board,
Mhm.
and that's informed a lot of my kind of approach to sort of doing things.
Mhm.
Um, in terms of like core lessons, man, like maybe like kind of big picture stuff first. Like venture is a really odd business where it requires a whole bunch of different things to go right.
Mhm.
And I would say they're an and statement rather than an or statement. So at Threshold, we say it's a see, pick, win
Mhm.
business. So you've got to, first you have to be in front of the right opportunities, right? You can't do investments if you don't see them when they're raising capital.
Mhm.
You see lots of investments, you got to evaluate them correctly. That's the picking part. And then maybe what's most unique about venture is, especially at the stage we're investing, which is, call it, hundreds of thousands of ARR to maybe millions of ARR. There's often just one lead investor slot,
Mhm.
right? And
Mhm.
so it's, the best deals are often competitive, not always, but often competitive.
Mhm.
And you have to, be the firm that the founders select to work with.
Mhm.
And so those are like, 3 sort of distinct skill sets. And then the funny thing about that is that only gets you on the 1 yard line
Mhm.
of a game that, is going to be a decade or more most often.
Mhm.
And so it's then working with the company over a very long period of time, doing what you can to
Mhm.
support them, help them through their journey, and then ultimately, get to the promised land of, some
Mhm.
sort of realization event, whether it's an IPO, M&A, whatever. When I mentioned the timeframes are long, like I had a board meeting this morning where I've been on the board for well north of a decade. I was on the Box board of directors for 14 years,
Mhm.
which is, kind of crazy if you imagine that as like a
Mhm.
human being. That's a pretty long journey.
Mhm.
Um, I think, one of the things I played. There are 2 things that have really, I think, kind of in my prior background that really inform my approach to investing. One is I actually went to college thinking I'd be a physics major and ended up graduating a social psychology major,
Mhm.
and was just fascinated in particular by group dynamics and cognitive biases and how those, when you get a group of people together, predictable set of things tends to occur that we're all familiar with if we've worked in organizations and sat in large meetings and such. And
Mhm.
I always say, businesses are made out of people. And so,
Mhm.
and, boardrooms certainly are, but, companies are made of people. And so
Mhm.
that's informed a lot of different things that we can drill into. The other was in my 20s, especially kind of like my when I was building my startup, I was working really hard. Sometimes you need some downtime, just like a mental break. And for me, that was playing poker. And poker is an expected value game, and the movies make it out like poker. Poker professionals are just better than you, and there's one big hand, and they can look into your soul, and it's always one big hand in the movies. And that's not at all how poker players or casinos make money. They make money by having an edge that is usually smaller than you'd think, but that it compounds and accrues. So when like N becomes large, over hundreds or thousands or tens of thousands of iterations, things conform to the expected value. And I think investing, particularly from venture, is a lot like that. So if you think about the journey of an investment, there's obviously some big decisions, like do you invest or not invest at the beginning, but there's literally hundreds or thousands of decisions that you make over the time frame of investment. And my philosophy has been to not worry about being perfect, but like just try and make that decisions that are on average better than 50%, and it compounds.
I really like what you said about like investing or companies made out of people, and we can definitely dive into that later on when we're talking about like board member or like how to be helpful for founders. But I want to start with like things that you briefly mentioned about like having access and then like the constant engagement with founders. So like since you have invested in some of the most iconic companies in the world, like I wonder, first of all, like how do you kind of like create some like the sourcing funnel for yourself? Because I feel like in the past, like maybe the DFJ era, there's like a lot of like brand that you can leverage, like the existing brand to go to something, but like building threshold and building a name for yourself consistently over the past 20 years, it's like something that's super important. Like, so how do you kind of having a source or like having access consistently with the founders, and then how frequently do you have like a cadence that you set up to chat with the people who are the founders on your radar, and how do they even get on your radar, or how do you be having more mind share for them when they start something, they will call you?
Yeah, there's a lot in there. So I think sourcing and sort of brand and reputation go hand in hand. One thing I'd flag is I think in most things in life, and definitely in venture, there's not one recipe for success. And so I think one of the best things I think people can do in their career is kind of know yourself and what you spike at and what you don't. Some venture investors are very thesis oriented, right? So they're kind of looking at technologies, markets, and then they'll go actually kind of hunt for the companies that kind of line up with that thesis. Some are more opportunistic and kind of tactical. So, one of my strongest memories was in my first year of VC. I was going through the Kaufman Fellows program, and Mike Moritz, who's obviously, legend, came and talked to us, and he said, I think of myself as a bird watcher, but I'm very careful not to make generalizations about species. I try and look at each bird on its own merits. And I was like, wow, that makes a lot of sense, right? So instead of just kind of dismissing, out of hand, kind of a category, or saying I'm interested in, ducks or whatever, really trying to just keep an open mind and look at things on their own merits, because especially early, it's often kind of non-obvious. I sometimes joke that like all of my successful investments had some sort of like head fake early on, right? So like with Box in 2006, we're coming out of the dot-com crash a few years before. There'd been some like XDrive, iDrive kind of high profile failures that had burned a ton of capital, never created much value. There was sort of a sense that storage was both easy, online, putting things online was both easy and also, it's just a commodity. And like, fast forward to today, in Boxes, like $1 billion to top line run rate and GAAP profitable, hundreds of millions of free cash flow. It's clearly not, right? So, there's something, LaunchDarkly, when I talk to kind of CTOs and VPs of engineering that I kind of trust, a lot of them said feature flagging is trivial. I could build that in a weekend. Cool. So you take that, if you took that at face value, you'd say, well, I'm not interested in this thing. But if you kind of really peeled the onion, yeah, you can build it in a weekend, but try maintaining it, both through massive scale and over long periods of time, kind of longitudinally, which brings me to one of my maxims, which is software engineering people often dramatically underestimate the cost of maintaining code. So they're very interested in building it, but not so much in maintaining and scaling it. So I've, for me, sourcing has, I tend to be pretty people driven. So having worked in venture for 20 years in the broader tech industry for now closer to 30, I've been really fortunate to work with some amazing people. And, I'd say easily, like me personally, easily half of my investments have come from one of my existing former coworkers or founders that I've worked with saying, hey, this person's amazing. You should talk to her. You should look at this technology. There's, someone that I know is really great, is impressed, I'm definitely going to take a look. And then there's like a subset of people where I've just learned the hard way. If they point me to something, just drop whatever I'm doing and look at that, because they haven't. I'll give one shout out, Jesse Robbins, who's now a partner at HeavyBit, and who we had backed back at his company that started as Opsco, became Chef. That guy has an unbelievable nose for the next big thing, in my experience. And I think that dovetails into, you're kind of asking about brand and reputation, which I think are sort of interlinked. We all kind of stand on the shoulders of the people that came before us. I was immensely lucky early in my career to work for DFJ. Tim and John had done an incredible job building that firm. They were very contrarian. They're very bold. When they backed things like Hotmail in the bubble, people thought they were crazy because, what do you mean free email? Like, how does that ever, Skype, free phone calls, right? And then even more so with like Tesla and SpaceX and the like. So, leveraging that brand certainly helped, but I think pretty rapidly you develop a reputation individually as well. And, I think it's not especially rocket science. The adage that reputation takes, years or decades to build and seconds to destroy is really true. It's like, kind of go back to kindergarten. It's like, treat people the way you would want to be treated. Do what you say what you mean. Just be kind of an honest, transparent person. Also don't forget kind of your the role that we play as investors. So like, it happens less now, but especially, 15 or 20 years ago, there was kind of like this mythology of like VCs as the heroes, which, we're not the ones in the game. We're not the players in the game. We're at best, coaches and probably more like spectators, really. And so, I think really just, the role of an investor is to do whatever they can to support the founder. And in my experience, what different founders' needs can dramatically vary. So you talked about like how often the cadence of checking in with the founder. I have some founders where I'm talking to them, multiple times a week. I might be talking to them, multiple times a day if they're in some sort of process that's kind of urgent, like a fundraise or an acquisition or something like that. I have other founders that I might talk to every couple months, or less, and that's totally fine. I think, like one of my maxims has always been to adapt my style or our style as a firm to what each company and each founder needs, rather than expect them to adapt to us. So I can recommend to people what I think the right cadence would be for talking. It's probably like every, week or two would be probably what I would recommend. But, if someone wants to do it more frequently or less frequently, that's great. It's their company and their journey.
I wonder, so like, how do you think about winning the tier one deals? So like, I feel like you have done this multiple times, including LaunchDarkly or Box, or like, I'm sure other stuff, that obviously you have so many portfolio in your network. That's like pretty great, like AngelList and everything. So how do you win over the top companies?
Well, I think first of all, not there's what are the tier one deals as perceived when they're raising their early rounds, and then there's what ends up being the top deals with the benefit of hindsight. And those, the Venn diagram on that overlaps, but I think probably less than one might think. So, going back to the head fake thing, I'd say, a lot of the best investments, not just for us, but I think for a lot of firms, aren't the ones that are like the shiny penny coming out of demo day or whatever. In terms of competing and going back to kind of like knowing yourself, I think, trying to do everything probably means doing most things poorly. Everything kind of comes at a cost. There's time ends up being by far the kind of limiting factor, just time and kind of mental bandwidth. A lot of venture firms over the last decade or so have gotten really big and have scaled, and there's like some positive things that you can do with that, in terms of you can have operating support, kind of for founders, you can have like operating partners helping with PR and marketing, recruiting, customer introductions, that kind of stuff. You can put out lots of great research, which is kind of like a magnet. I think like Bessemer, for example, does a fabulous job with all of the Cloud Index and Cloud 100 and research reports that they put out. But there's a cost to that also in terms of the team. So like one of my observations, both as a founder and as a VC, was that if you're trying to make the best possible decisions and move at an appropriate pace, I make better decisions with my co-founder Emily than I would by myself. And if you add my partners like Mo and Arpit and Megan and Lisa, like that, the decisions get better and better. But right around, like, I'd say probably 6-7 people, like the number of people that can fit around like a modest sized table, I would argue the decisions actually get worse. Like we've all sat in like a 30-40 person meeting. Those things are not decision-making meetings. Those are like reporting, communicating information kind of meetings. And so I think there's a cost to having like 100 investors at a firm. I think when you have hundreds and hundreds of companies within a venture firm, it's really unlikely that you're getting the full resources and attention of that firm. Like it's not physically possible for every partner to know every founder at that scale, right? Or even I won't name names, but I remember as an entrepreneur, back when I was an entrepreneur, running into GPs at some of my bigger investors, they would have no idea who I was, and they have no idea what my company did, even though they'd invested 8 figures into the business, which especially back then to me seemed like a ludicrous amount of money. So I think like where threshold spikes, we call it air game and ground game. So the air game is like putting out opinionated research pieces and blog posts and tweets and things like that. And the ground game is like the showing up and helping the companies, like being the person that's kind of the first call for the founders, advising them in the board meetings, kind of helping things kind of stay on track. I think we spike on the ground game. I think we've just sort of accepted the fact that we're not the air game specialists. So we, you don't see us in the press as much. You don't see us doing things like this quite as much. And it's not because we're like, we think there's anything wrong with it. It's just like when we have to prioritize, we prioritize how do we work with our portfolio companies first. And, that kind of creates a virtuous cycle for us. So how do we compete with firms that might have more like unaided brand recognition? So I think we have good aided brand. Like if you say to people, have you heard of Threshold Ventures? I think there's a pretty decent percentage of people that have heard of us. But if you say name a venture firm, people are more likely to say some of the bigger names. So I think how we compete is, frankly, when we get an entrepreneur where we've said, hey, we'd love to invest, and here's a term sheet. One of the first things we do is say, look, you should, please talk to our existing CEOs. Our portfolio is our reference list. Pick whoever you want. And when founders talk to our existing founders, that tends to put us in very good standing, especially at the early stage, where I think it really matters.
How do you pick a co-founder? So obviously you guys have worked previously, but like I guess like how do you kind of like split up the work? So it like, in terms of like I feel like building a venture firm is different than like just investing, right? So even investing, you have like sourcing, diligencing, like winning, exiting, everything like the thought process. But like in terms of building the firm, there's like the fundraising, the, uh portfolio management, as well as just like brand building, hiring people, everything. So like how do you think about building a successful firm?
Yeah, it turns out there's a lot more than just the investing side. And being a small firm, we end up having to do a lot as well. Maybe starting with like, how did I pick my co-founder, and how would I advise other people who are starting a venture fund or really anything to think about being their co-founder? It's like, for me, the simple acid test is, I would happily take half of Emily and I's combined output over 100% of my own. So if you want to get like real brass tacks about it, like that's how a partnership should
Mhm.
be. I think I'm getting the better end of that trade, and hopefully I think she does as well. And we've been, making that trade for a long time now, and I would happily sign something to say that's a lifetime deal, for the rest of my career.
Mhm.
And so, I think another thing is, yeah, I was at Stanford Business School in '99, so it was a very prolific year for starting companies. A very large percentage of my classmates, including myself, went and started a
Mhm.
company coming out of that, which is, a fun fact. If you look at what like HBS and Stanford Business School students are doing, it's often counter correlated with what you should be doing. So
Mhm.
they tend to sort of predict market crashes pretty well by storming into something. Um, uh, I think having a founder or having a co-founder that is different than you is important. So like Emily and I are people who know us, we're really different people, like personality types, cognitive styles, our strengths, weaknesses. And I think that's the strength, where to make good decisions, you need to have people who are pushing your thinking, who are seeing things differently than you do, who are kind of looking around corners. If I think about the most impactful decisions in my career, Emily's fingerprints have been all over a lot of them, right? Where she either pushed me to do something or not to do something, that helped, me either have a win or avoid kind of a self-inflicted loss. And you if you pay attention to the people in your life, you realize who those people are. And when you find them, you got to like, hang on to them and listen to them. And um, I think that, particularly if you have that duration of time with somebody too, you really can build kind of the rapport where, you can disagree, and it's, you're talking about ideas. You're not, making some statement about the person's worth or character or something like that. If I think about founders that I've backed, I think a lot of the most successful founding teams have been like that, where they've, had really different personalities, and also, very clear strengths and weaknesses. It helps, if they're not overlapping. So if you have three people that are clones of each other, they're probably not going to be that additive. And the like a classic thing is like, you see like the two co-CEOs, or I've even seen like three co-CEOs. I mean, what a disaster, like just not a good way to go. There's an exception every rule. I've also seen co-CEO work, but it's like not the recommended path. Um, so yeah, and I think we extend that to the rest of the team. So as we've built the team at Threshold, we've tried to say, look, who are people where, you want, smart and curious, and obviously, table stakes are like, good person, ethical, transparent, all of that, hardworking, but also people that, just add something to that mix.
Um, I wonder, so how do you think of like I want to maybe go back to since like you built your own fund um over 11 years ago, and I wonder
Yep.
how do you think about fund 1 to fund 3 and then versus, right now, it's been like 11 years. So how do you think about like, things that you've done right that kind of like got you to where you are? Because obviously, continuously having multiple funds is like, you have to demonstrate the performance and everything else. But like, I guess I want to ask, like, maybe what does a 0 to 1 stage kind of like look like for you to build your own firm?
Yeah. Yeah, it can seem like when you're starting at 0, like 0 to 1's tough, right? It's like it's a heavy lift. I think the secret is to, just start going, and then, the progress tends to compound. It's like, we've all, if you've done hard things like, run a marathon or something like that, it's amazing how like the last bit, at least for me, the last bit's always dramatically easier than like the first half. It's like if you're imagine like running a long distance out and back, the way out is tough because you're just getting further and further away. When you're coming back, especially as you're getting towards the end, it's like it feels like super super easy. So I think, with one thing that's really important, I think in life, but also in investing, and this is like, it goes to like the kind of cognitive biases thing, is trying to be intellectually honest, which is actually harder than it sounds. Our brains play tricks on us. Like we have a tendency to, kind of our memories are imperfect. Like you go to without going too far down the rabbit hole of like how brains actually store information and memories. It's an imperfect process, right? And so we tend to have a bias towards remembering things in a way that's more favorable to ourselves. One of the things I like to do is write things down. So whether it's like investment memos or emails, kind of explaining thinking, and then go back to those over time. And it's shocking sometimes when in your mind, you'll think, oh, I always liked that founder. I always thought that investment was going to be great. And then you read the emails and you realize it was totally the opposite, right? Or, maybe you were wishy-washy or something. I think poker taught me to not confuse outcomes with process. So, on any given hand or any given decision, there's variance and luck and chance involved. But if you have a rigorous process and a process that you're looking to improve and refine over time, you're going to make better than average decisions over the long haul. And again, that will kind of compound. So like one of the things that's least useful, I think in startups and in venture is like finger pointing with the benefit of hindsight. So like critiquing things based on what ended up happening as opposed to was the process right. So I think the right questions to ask when you're doing like a postmortem on either a success or a failure is, what could we have done differently in our process that would have led better outcome, or what in our process led to this, us being able to do this good thing if it was a success. And it's important to also remember, like, let's say you launch a company and, a year or two later, one of the giants, NVIDIA, Google, Microsoft, whatever, launches a competing product and just kind of, kills the market. Could you have possibly known that ahead of time? Maybe, right? Was it foreseeable? Was there a way to predict that? Were there calls you could have made that might have uncovered that was a possibility? Like there's technology is endlessly entertaining and intriguing because there's always huge changes happening. Like this week, everyone's talking about DeepSeek, and like it's just totally upended a lot of the core assumptions around the kind of economics and scaling of the foundational models. Like, was that knowable, right? So, if you're investor one of the like OpenAI, and you're freaking out because you're like, oh geez, maybe my moat's not as big as I thought it was, or maybe the rules have changed. Like, could you have known that when you were doing the underwrite? I don't know the answer to that, but like that's the right question to ask rather than say, I can't believe you got us into this fine mess. So I think like, improving your process that way continuously is a way to go. Yeah, let me pause there. I tend to talk a lot.
No, I don't think it, I like the answer. And I wonder, so when you're thinking about filtering the type of deal that you invest in, maybe we could use any of your current portfolio as an example. I think I listened to an interview you did in like 2017. You just invested in LaunchDarkly. And then how do you really filter? So like I listened to the story about like how you invest in Box, which is, Aaron and his co-founder just like he gave you the answer that are like super thoughtful in a really fast manner. So, but I wonder, so how do you think about, I guess, like, what not to invest in? Because like the deep seek thing, it's like right now it's very popular. Obviously, a lot of it's like a very contrarian than what people think a week ago, basically. How do you kind of like accept these kind of really contrarian idea, and how do you pick, I guess, like maybe we'll just walk through like your filtering process, because I feel like that's really important too. A lot of VC just talk to an expert, let's say introduce like XYZ to like a potential client or like other investors to see if they can close, and obviously that's like a good way to test if they could actually sell a product. But is that enough? Or do you like, how do you have create like a process for you to make sure you examine each different company in the same process? Because you also mentioned outcome. Um, it does not mean like the process. So the process doesn't really dominate the outcome. But how do you kind of like get a consistent outcome from your processes that you build filtering companies that to invest in or not?
Yeah. So maybe just clarifying one thing, like a strong process does not guarantee a good outcome every time. And I think you
Yeah,
just have to
yeah,
kind of accept that there's, variance in life and things that were
yeah.
unknowable and, coincidences,
Mhm.
luck, whatever you want to call it. But I think a strong and continuously improving process will ensure a much better outcome on average than a weak process, right? And I think you can in a casino it would be you just need to be north of 50%, right? It's like if your house has a 2% edge, they're going to get all your money if you play 1,000 hands, stuff like that. In terms of like the filtering process, it's one of the hardest things because like you know you the volume of things that like there's like warm intros from someone you trust that come in that obviously are going to be prioritized, but also you just you hear about things, you read about things. Like there's if you think about the number of new companies that are started in a given year, it's a very large number. So if you think about even just like applying a superficial screening to that set of opportunities, it's a lot of time. You've got to be able to prioritize like which ones are the ones that I go deep in. So part of that is like, well, what's the quick no filter, right? Some of that relates to, again, going back to kind of like know yourself, know what your power alley is, your strike zone. Like for us, one thing is stage. Like we, with limited exceptions on either side, we generally don't invest in things at threshold that are pre-revenue. We want to have some sense that it's more than an idea, that it's working. And we're not writing, super large checks at high valuations as passive investors. So we kind of say, more than an idea, less than a scaled business. Call it up to 10 million of ARR or something like that. That helps create a filter. We have a fund size that we think is primarily driven by, we kind of start with how many investors we think we want around the table to make the best possible decisions. We know the stage that we're investing in, we know what that check size looks like, and we know roughly how many investments we think we can do each year, and also how many investments we want to have steady state in terms of like, I would never want to be on like 20 boards like that. You would just do all of them poorly. For us, the fund size is kind of the output, right? And that's, our last fund was 375 million plus a sidecar for kind of like going deeper in the best companies of 75. So call it, 350 to 400 million. That precludes, we're not going to write $100 million check into a single company. So that precludes a bunch of stuff right there. So that's like one kind of filter. I think, you mentioned like the box story. I think, there are a couple of factors at work there. Aaron and Dylan and Sam and Jeff were all, in their very early 20s when we invested. So they've changed a lot in the last 15 plus years now. But even back then, you just had a sense when you talked to them, like they had a contagious energy and enthusiasm, and they were sharp, and they, the job of a startup founder at some level is to be like a magnet, right? For human talent to come work at your company, for customers to take a bet on unproven technology, capital, to attract capital. It's like, if you're sitting with someone, you want to feel compelled. Like, I can't, this is so exciting what this person's telling me. I can't, I want the meeting to go longer, not shorter. I've learned actually the hard way that blink decisions are not usually the best idea. So like, it's not like a hard and fast maxim, but it's sort of like, I try to avoid forming judgments in the first like 5 minutes. But if someone doesn't have you kind of, have your full attention within the first like 10 or 15 minutes, they're probably not going to get it. Right. So it's sort of like, it's like that. Some people take a little while to kind of, warm up. And some people grab your attention immediately, but then kind of lose it. It's like, do they grab my attention in the first like 5 to 15 minutes, and then can they hold it? Like, if I find myself going like, oh my God, I can't believe it's time for the meeting to end, shoot, like, and you're disappointed, that's a great sign, right, for an investment. I think, one thing that's often, I think, poorly appreciated in venture is like, there's risk and reward, right? So if you're investing, $1 million for 25% of a business, you should be willing to take a lot more risk than if you're investing $20 million for 5% of a business, right? Like, the level of proof that you are looking for is very different. In venture, your upside, your gains are really governed by your ownership in the company. So if the company's gonna be worth X billion dollars at some point in the future, and it's better to own 20% than it is to own 5%. And you let's say you own 20% at a $10 billion IPO, so you've shares that are worth $2 billion. At that point, it doesn't super matter if your cost basis was 2 million or 20 million, right? I mean, it's almost like a rounding error in the multiples and stuff. But it makes a big difference, obviously, in terms of the fund size that you need, and then to be able to take those the number of bets that are necessary. I think another kind of perennial debate in venture, which I think it was Don Valentine, the founder of Sequoia, who called it the jockey or horse question. Like, what's more important? Is it, the kind of like the market or the team, or the technology of the team, product of team, whatever you want to call it. I tend to skew towards people. My view is that really talented, motivated, tenacious, serious founders often end up finding an opportunity, even if their initial idea was not the exact correct thesis. But there are some investors who are very successful who tell you just the opposite. That, like, I think it's Warren Buffett who said, when an A team and a D market meet, it's the market that emerges with its reputation intact. So, but I think that, like, again, it's stage dependent. Like, that's probably true as if you're a Berkshire Hathaway scale company. But I think Box did not start out with a focus on business customers when we invested. It was a consumer company, for example. We've had much more dramatic pivots, like in the startup ecosystem. I mean, like Stuart Butterfield at Slack, which I was not smart enough to invest in. Both of his companies, Flickr and Slack, started out as video games, right? Like they complete pivot. Twitter started out as podcasting platform, audio. So sometimes you just find these incredible people. They find the opportunity. And then I think it's also there's making money, and then there's like also kind of the psychic satisfaction that comes with some investments. Like, I think as an investor and a fiduciary of LP's capital, obviously your primary duty is to generate great returns. But I think we'd all like to be involved with companies like change the world in a positive way. It's sort of trite to say, but it's true. It's like it's nice to be involved with things that like bring people joy, or improve society, or improve economic well-being, whatever it is. So like that's kind of another filter. Like there have been a number of investments. I will not name names, but there are a couple of public companies that I at least financially incorrectly passed on, because I just thought, like, these are not good for society. Like I won't name a name, but I'll say, like, one that comes to mind is in financial services, and I thought it was predatory, like the way that they were making their money. They say like, if with free services, like, you are the product, right? Like it's one of these, like, you get this thing that you used to pay for free. Well, how does the company afford to do that? Well, they were, sort of making money behind the scenes in a way that I thought was disadvantageous to their customers and kind of unethical. It's a large public company now, so from a quantitative standpoint, I was wrong, but like I wouldn't have slept well at night. I guess one other one I'd say is like kind of relates to the large checks, but like also with like going back to like the foundational models. There's some businesses that are you just know they're gonna be massively capital intensive, and we, given our fund size, that's something that we just try and stay away from. So the classic example would be something making a physical product where you have to like have a factory. Like those are tough for a small fund because it's binary. Like with Tesla, there was no, you're building a car, like there's no middle ground. You're going to have to spend a billion, billions, whatever it is, of dollars to produce that first unit. AI, one of the things I like about software is the inherent tunability of the businesses for different market conditions. But it just doesn't work with our fund structure. One last thing I'd say. So one fun thing about having done this for a while now, like, I am a huge optimist. The world is, in my view, almost always moving in a positive direction over any reasonable time period. There's one of the more famous psychological, it's called rosy retrospective bias. So if you survey people and you say, and you ask them in a little bit more of a involved way, but the gist of it is, were things better in the past and are they getting worse in the future? At every point in time over the last 50 years, a majority of people would agree that things were better in the past. Every quantitative data point you can think of would suggest the opposite. Infant mortality, people living in extreme poverty, homicides, like it's like literally everything is getting better over the long haul, but things also move in cycles. So like you'll have, exuberance like the dot-com bubble or the global financial crisis in the late 2000s. And you got to navigate through those. Operating companies in a way that they can sort of, it's like if you're driving 100 miles an hour, you got to be ready to hit the occasional pothole and not have it, throw you into the wall. And that's harder if you need, $1 billion to build that plant, and you were in a, post-COVID ZIRP, zero interest rate environment. Capital is really cheap. Fast forward to like 2002 and interest rates go up by 500 basis points in a year. If you're needing to get a lot of capital and debt, that's a big change.
For sure. I want to double click on like you mentioned about like we chat briefly about like the ownership, being a lead investor, and like, so I wonder, how do you like lead or / like creating a valuation? What's your valuation threshold? And how do you kind of think about like portfolio construction? Since like I feel like it's, since you have like, almost like, you have two funds and then they're like 375 million, 75 millions. But as a smaller fund, if you, let's say fund one, you have like $10 million, you can do this pray and pray approach, just invest in the same amount to every company. But like when your fund gets bigger, how do you think about like leading which company at what kind of valuation? Because the valuation you have to actually define as a lead investor. And I also recently heard that like smaller investor can also be a lead investor rarely. And like, technically you just bring other investor to like co-invest with you. And how do you think about the synergy and the co-investing? Because it's kind of like it's a weird vibe. So like you have to like collaborate with someone this round or like, but also fight with them in another round. And like, how do you think about like the synergy there?
I was just thinking you're asking amazing questions, and there's like 4 or 5 questions.
I'm so sorry.
In each one. So, no, it's a good
about,
test
like,
for my memory.
yeah, so sorry. I'm like very over the place.
No, not at all. They're really good questions. Lead investing. So it's actually somewhat analogous to like how do founders become founders, and why is the founding CEO the founding CEO? It's like, are people willing to follow you is sort of the definition. Like you kind of earn the right to lead by people voting to follow you with either their time or their money or both. It's probably most typical in venture rounds that the lead investor is the largest investor in a round. That's like the most common thing, but it's not a rule by any means. I mean, we've led rounds with 20% of the capital in a round, something like that. And so it really comes down to like, do people want to follow along? Leading's tough work. You got to sit down with the company and negotiate the terms and the other investors and kind of everybody's there's every decision maker, you're going to make some people unhappy and some people happy, and you just got to kind of navigate that. So I think I think especially as funds have gotten bigger and people their attention has gotten more diffused, I think there's a premium on the leadership kind of function, whether that's leading around or leading at a board, like where you may not have an official title of chairperson or lead director, but there's always somebody who's kind of helping to sort of drive the ship, and we aspire to not driving the ship, I promise, like let's say just sort of bringing people together around consensus. Like at some point decisions need to be made, and it's easy for groups of people to kind of spiral, especially when things are not going perfectly to plan. And I think we aspire to be that where we can at the companies. You asked about portfolio construction. One of the most interesting things, and earlier you mentioned there's a lot of other things beyond investing that go into a venture fund, portfolio construction being one of them, LP management, hiring, etc. We're also companies ourselves, right? So we have, employees and stuff to manage. None of that stuff is taught, to my knowledge, as like courses in business school, which is, or in any school, which is kind of crazy. It's like tribal knowledge that is sort of picked up. I was very lucky starting as a partner in TFJ and being a pretty transparent and open organization. I got to sort of sit in the room as those decisions were made, and you sort of form your own theses about the right way to do things or not do things. Like a simple one for us at Threshold is we have pretty strong beliefs about having enough diversification that there's a good to better than good chance that each of our funds will have a good or better outcome. But if you have too much diversification, you actually kind of ensure a mediocre outcome, right? So like most modern portfolio theory would say, in any portfolio of public stocks, there's sort of marginal value to diversification beyond about 15 positions. In early stage venture, we think it's a little more. So we think the right number is like kind of 20 to 25 per fund for aggregation of companies. And then, we raise the next fund when we hit that number. It also lines up with that's about the number of deals that our team can do in a 2.5 year plus or minus cycle, which we also think is the right amount of time. It's not a good idea to raise a venture fund every year, in my opinion, because you're so localized in like one macroeconomic condition or in one kind of slice of time. So you want to have some diversification through time. But it's not a good idea to have the funds be invested over like 5 years either. If you have the last deal in that fund, if it's an early stage deal, it's being held to a standard of a fund that's looking to wind up in 5 years. That's not great, right? And it's tough on both the fund and the company. So a lot of it, we've kind of formed those convictions over time. There are a couple other really good questions in there, and I think it was
yeah. So okay, so I am so sorry. Like I have another question in this domain, which is like I guess like for like picking, so like when you answered about like the picking lead or not lead or like the ownership, like like you mentioned about portfolio construction, 20 to 25 companies, do you invest in the same check size or no? Or is this like, so how do you think about, and then follow on, do you just follow on everybody, save half, no pain, no gain vibe?
Yeah. So I think I kind of think of it as like a 2 sigma distribution. So there's always some stuff on either side. Like for us, I'd say our mean median initial check size is around 10 million, like right around 10. And kind of think of it as 5 to 15 as a first check. And then we when you say kind of save the like, you mean it's called reserves in the industry, where you sort of reserve capital for following rounds. And you do that both because you when you're supporting a company in future rounds and you're, let's say, talking to new investors who might invest in the company, they're going to want to see you put in new capital as well. It's the best signal you can send about your belief in the company is putting in more money. In our case, we reserve capital so that, especially in our best companies, we can deploy 2 or even 3 times our initial check. So if you look at our companies that have gone public or had great M&A exits, it's not uncommon. Even though our initial checks are around 10, it's not uncommon for us to have 25, 30, or even more invested in those companies. And you can drive a material amount of your funds returns by being good at that, by putting more capital behind the best companies and trying to not dig deeper holes in the cases where things are not going to work out for whatever reason. I think that's also part of like focus. Like there's a well-known thing in just investing broadly across all asset classes called style drift. So you'll see like a hedge fund that launches with $200 million and they kill it for the first 5 years, and then they raise $2 billion and it just all goes to hell. Or they start out and they're great as investors in software and they say we're going to add clean tech and we're going to add whatever, quantum computing, China. And it turns out like you might be the best at one thing or one scale, but like when you try and do everything, it's unlikely you're going to be the best at everything. So trying to it can be hard to not expand, but I think it's important to have that kind of discipline. And I would say that we really have a bias against adding new strategies or size unless we have a very specific thesis for why we think that's going to be additive. We're almost like a little gun shy, I think, about that, which is probably a net good thing. Lots of benefits of being a smaller fund as well, like just the way the math works. Going back to kind of the companies exiting at 10 billion, which is an amazing outcome. Like that happens, but it doesn't happen as often as people would think. And you own 10%, 15%, which would be a very material ownership in like a company like that. You're bringing back $1 billion, $1.5 billion. Who cares? Even if your cost basis was zero, if you have a $3 billion fund, $5 billion fund, it barely moves the needle. If you're going to have a huge winner and be a double-digit percentage owner, and that doesn't move your fund, I would suggest you have a structural problem. For us, that would be multiple turns of our fund.
How do you think about like the competitor or like co-lead, or not co-lead, but like people who does like the rest of the runs? How do you think about like that kind of stuff? So like if they are interested in a similar deal, sometimes they may be like a competitor or something. Some funds lead and not lead at the same time. Like, do you intro them, or like how do you think about that? And then do you already have a term sheet in hand and then you introduce people, or like do you soft circle to see if this thing actually will happen? And if you got enough like synergies or like the vibe check, then you invest together. How do you think about that, like the collaboration around?
Well, you're touching on something really important. So, one of the things that got really venture grew in terms of as an industry in terms of headcount really substantially, right? So it was, when I started, it was much more of kind of a cottage industry, and now you have much bigger firms, more firms. It's like the number of VCs is like a significant multiple of like when I started the business, and a lot of folks have brought over things that are more common in other areas, like in investment banking or consulting. When I'm looking at an early stage deal, well, you always want to be cognizant of like what prevailing opinion is. One of the things I'm least interested in is what other investors or other firms think. It's such a judgment call. The best ideas usually are contrarian. But I'm not that interested in hearing that firm X is all over this deal, or if people are like, we looked at that and we passed. Cool. Like, you're good chance you're wrong. Like, I'm going to do my own analysis and form my own judgment. That's at like the rounds that, the early stage where we invest. Later on, and interesting about being a smaller fund, or really any fund, is you do need to partner with new investors over time. Like our fund size is not sufficient that we're going to fund the company's full capital needs all the way to victory. And it's sort of like co-opetition, I've heard it called, where we might be competing with a firm to lead one round, but we might be partnering with them on another round. I think something that's often not appreciated enough is VCs also build trust level and conviction in each other over time. So if you've been on a board with an individual or with a firm and you've seen them act correctly and be consistent and fair and transparent and sort of good actors, you're much more likely to want to work with them again. And I can and do often will say to a founder, hey, look, I've worked with this person before, this firm before, and I've consistently seen them do the right thing. And I know that the relationship that we have transcends like just this investment. So it's also like, that's a good thing, right? It's like sort of a repeated interaction game. By the same token, there's firms and people that I've seen act poorly, and it makes you less likely to want to work with them. And, you have an obligation to say to a founder, look, it's going to be your decision. Like, it's your decision, but like I've seen them kind of under pressure before, and they didn't do the right thing. So it kind of goes back to that reputation point. It's like you build the reputation over years and years of, kind of showing up and acting the way that people should act. And, I think short-term optimization is not a very good strategy for long-term success in startups and in venture.
I want to be mindful of time. I have one real question and a quick
Yeah.
1 minute fire round for you. Okay, so I wonder, since you're on a bunch of different boards, and what is board director what is one question that you get as a board member that you find surprising? And okay, so what will happen after, since you already run your fund for over 11 years, what does it mean to run a fund for 10 years? Because, the fund cycle is 10 years generally. And then in the first 2, 3 years or 4 years that you deploy the whole fund. And then meanwhile, you raise the second, third fund. But, people always say, oh, it's a long game. If let's say you and someone start a fund, you already have a co-founder. So you and your co-founder start a fund. And then how does 10-year progress? The 10-year mark, do you have to file a major report to all the LPs to be like, hey, by the way, we're close on the fund one, here's our return, yada yada yada, or what will happen in 10 years? Because I constantly hear people say, oh, it's a long partnership, blah blah blah, but I don't really know what that means, because you deploy in 2 years, right?
We aim for a 2.5-year cycle plus or minus 6 months. So call it 2 to 3. We try to be not faster than 2 and not longer than 3 in an ideal world. You make a good point. I think there's venture capital firms, the people, the company, the brand, and then there's specific funds. So we have threshold 1, 2, 3, 4. We're investing currently at a threshold 4. So each one of those is its own entity with a 10-year clock. Venture funds typically have a 10-year life. I would say most people in the industry recognize that, especially over the last 10 years, the funds tend to take longer to come to a full realization than that. But typically, the limited partners who put a huge amount of trust in the GPs, effectively have no say in how their capital is deployed. So it's a big trust commitment. Get quarterly reporting. There's an annual meeting every year where they can sit down and hear about the portfolio. They can ask questions, and then every firm does it differently. But we don't have a professional IR person. Emily and I do that individually, personally, and we just tell our LPs, you ever have a question, just pick up the phone, ask, right? So we try to be very available and accessible to our LPs to recognize that trust they place in us.
Does anyone just ask nonstop? I'm so sorry.
That's okay.
Yeah, I just suddenly have this question. Yeah, do people just actually will call, or will this be just people will take a look at the report and then ask a few questions here and there?
I think when people are trusting you with a lot of money, it's perfectly reasonable to have a bunch of questions. I think in the same way that we try to pick great companies, I think if you have the luxury of being able to pick among your LPs, which having been doing it for all and had good results, we have the luxury of doing that. You want to find LPs that are also act well, right? That are appropriately cognizant of is that Like if you spend all your time talking to your LPs and not doing the investing, that's not good for the LP, right? Because you're not generating the value. But like we look for LPs that also have a very long time horizon. So in an ideal world for us, as long as we generate the investment returns, we want to know that the LPs are going to be there and want to back us in successive funds. So for like at a high level, like we and other top venture funds tend to skew away from like wanting to raise money from individuals, because individuals tend to be a little more, even if they're very wealthy, they tend to be a little more emotional about, because it's their money, versus like an endowment or a pension fund who's thinking in decades, right? And where the people you're dealing with have a layer of remove from kind of maybe like some of the emotional ups and downs. When you have something happen like the global financial crisis, even the most calm people can get a little wonky, myself included. And so it's just it's good to have professionals around the table. Some of our LPs, by the way, are also super value adding in terms of like we have our own board of directors. It's called a limited partner advisory council for each fund, and they're like our board that we can consult with for things. You asked about like questions that we get surprise me. The biggest thing I think is people misunderstand the roles of boards. I think a board is there. Legally, a board is there to be a fiduciary to shareholders, make sure that shareholders' interests are being represented, which includes, everyone, including the employees, the founders, et cetera. But I think people think like boards are directive or should be directive, like they're the ultimate decision maker. That is absolutely not the case. A board is there to be a sounding board for management and CEO. So the role of a board is to push thinking and say, hey, did you think about this? Or, have you considered that? Or, talk me through your logic, right? But at the end, for me, at least, the end of the day, the decision is always management's. So if a founder or a CEO says to me, I'm trying to debate which VP of sales I should hire, I'm happy to interview. I'm happy to give my feedback. If I think someone's horrible or I think someone's amazing, I'll tell them. But it's always the CEO's decision in my mind. If you have a board trying to make decisions beyond really just like the hiring and firing of the CEO, I think you've lost your way.
Totally. Okay, I want to wrap up with like a 30-second fire round.
Sure.
What's your favorite book?
Oh, my favorite book. Geez. Boy, there's a lot of good ones. So, I'd have to
Well, most people don't read, so it's okay.
Like nonfiction, fiction, like I don't know. Maybe like first thing popped in my head is honestly like Count on Monte Cristo or something like that, or like Delaire's book of Greek myths, like back when but more like on the fiction side. It's not really business relevant.
That's great.
Okay.
Wait.
Yeah,
who made the biggest impact in your career?
There's been a lot of folks. I mean, I would have to say Emily. I mean, it sounds silly, but like as my co-owner, but like the duration of time we spent together and the number, like if I think of like the 5 most impactful decisions in my business career, like I would have made the wrong decision, half of them at least, without her.
Who would you invite to your dinner party?
Who would I invite to a dinner party? Yeah, it's a tough one.
Josh, it's a fire round. Okay, so
I don't do well with fire rounds. I don't know.
Okay, where can we find you outside of work?
Outside of work, it's funny. I like to travel a lot. Like I try and go see new places. I'm also like the one thing in my personal life, like I know I'm like better than average at, is skiing, and so that's kind of like my happy place.
Wow, love that. Well, Josh, thank you so much for coming on the show today. It was such a great lesson in how to build a successful VC firm and invest.
I'll work on my fire round ones.
Okay, amazing. Okay, let me quickly end stream.